I want to welcome in Eddie Ghabour, owner of Key Advisors Wealth Management. Eddie, thank you so much for joining us today. I almost say happy Friday because it's the end of the trading week here. But let's talk about your overall perspective on the market and how you characterize it recently. A lot of people say this is an opportunity to buy the dip, buy the dip, buy the dip. You don't think that. What do you say?
No, I think this is a sell the rip market. I don't think anyone should be really debating whether we're in a bear market or bull market. I mean, you look at the losses on the tech side, which is heavily weighted to the indexes. The trend is extremely bearish, and uncertainty is at levels we haven't seen since COVID. So trying to pick a bottom here and saying buy dips, in my opinion, is extremely dangerous at this juncture if you're fully invested. We are not fully invested. So if you're positioned with a lot of cash and gold like we are, then you can try to be cute and trade this short term. But I think when we look over the next few months, we are going to see that the economy is slowing down much faster than the market has priced in. And that's not priced in fully to this market. So we expect us to touch at least the lows and probably break in new lows here in the coming months. We think this quarter is going to be the worst because of earnings, because of the data that's going to come in, and because the Fed is not going to save us this time. So we're going to be looking to be aggressive buyers, but it's probably going to be late second quarter, early third quarter based on how we see the math lining up.
So let me ask you, in terms of the indicators that you're looking for, what indicators are you watching to see a C shift then when it becomes not a sell the rip kind of market from your perspective?
Well, one of the main things, frankly, from a business sentiment standpoint is to get clarity on what trade deals are going to look like. That's going to have a big impact on what forward earnings and forward growth is going to look like. And until we have certainty there, it's nothing more than a guess. So we need to see clarity in regards to trade. And we have to stop making lower lows on the market and these names. You look at names like NVIDIA that are highly owned, right? Once they bounce and they hit certain levels, they sell off aggressively and make lower lows. And until we see that trend stop, in conjunction with the VIX, we need the VIX in the low 20s. We're having a hard time breaking 30, and it's been ranging between 30 and 60 here. That is not an environment that screams buy the dip. We need that VIX to really come down and get volatility under control.
Okay. I want to get your thoughts on gold because I know you have some thoughts there. It's a little bit lower today, but it has been in a bull market. What's your expectation in terms of the patterns for gold throughout this year?
I think gold is one of the things that has flown under the radar somehow. Even though it beat the S&P last year, it's up another 20+% for our clients so far on a year-to-date basis. And so because of that, and because it's under-owned, I think you're going to see money flowing from bonds, which have been in a bear market, looking for defense, which is going to be gold. And then I think as uncertainty continues to rise with the economy, if we are right on growth slowing at a faster pace, I think that's going to add even more money flows going to gold. So I think gold is going to continue to get new highs. And on days like today, where you're getting a 1 to 1.5% pullback, depending upon what time of day it is, if someone doesn't have gold, that is an area that I would be buying dips in. We have a 10 to 15% position right now in gold for clients based on their allocation, and it has been a home run this year so far.
Okay, so there is where you would say buy the dip. I would argue that gold was essentially neck and neck with the S&P 500 last year. It was very close. But both bull cases last year, certainly a very different case this year. Your expectation for earnings this quarter, are you expecting it to act as what are you looking for from this quarter? Are you worried about guidance this quarter? Do you think clarity is going to be missing this quarter because of the tariffs?
I do. And I think if you think about it, right, I think companies have a lot of incentive to throw the kitchen sink on earnings and give the worst case scenario because I think people are expecting it. Their stocks have already been clobbered in many of these names. And so they're in their best interest to just get it all behind them in this quarter. And then the comps moving forward will be easier to beat. So we expect earnings to be really challenged when we look at forward guidance. And you look at companies like Walmart, I believe they just last week or this week just pulled forward guidance. And that just kind of goes to show with the uncertainty. And you look at a company like Walmart, I mean, if there's any company that has a pulse on middle America, it is Walmart. And so that spoke volumes to us. And, you know, tech earnings start at the beginning of May. So if we get a rally this next week because there's a trade deal done with Japan and Europe, I would look at that for fully invested investors to maybe take some off the top, because once we get to May with these tech earnings really start to go into full gear, that could be a potential for the next leg down.
So if your view is that the economy is going to deteriorate a little bit from here, or you're worried about some of it right now, we have seen some mixed economic indicators. What sectors do you believe their valuations are misaligned with where they should be?
So I think tech, you know, and why I say tech is because of the way the market structure is right now. It is so highly concentrated. We have a handful of names that have really moved this market. And so I think there's still more downside there. And the reason why is when you get growth scares, I don't think we're going into a recession. I think we're going to have a major growth scare because of what's happening right now under the hood. What happens is your growth companies are the ones that get sold. And because of how highly concentrated a handful of the names are, the Mag 7, our concern is those are going to get aggressively sold off, and that takes the broad market down with it. And so that is an area that also will give us the best opportunities, because the positive is once we get through this quarter, I think we're going to have some opportunities that we haven't seen since COVID. And if you play it right, you could have really nice upside for the next several years in portfolios.
Yeah, well, a lot of tech has already been heavily beaten down this year. So some would argue, given that many are already in a bear market, that the valuations have been accounted for there. But Eddie, we have to leave our conversation there just for the sake of time. I always love hearing your insight. Very smart takes you have. Eddie Ghabour, owner of Key Advisors Wealth Management. Thanks so much for joining us today, Eddie. Have a great weekend.